will be talking today about funding your business, the complete loan package. I'll be your presenter. My name is Ellen Harvey. I'm a certified business advisor for the Ohio Small Business Development Center. Again, we are located at Columbus State Community College. I am also over a crowdfunding platform that we support called Kiva. So we are the hub for Kiva Columbus, and I also specialize in access to capital, be it business loans or commercial loans, to assist you not only in helping you to prepare your package, but also helping you get through that loan process as far as getting the funding that you need for your business, whether you're a startup or an existing business looking to expand. So thank you again for joining us. If you are not familiar with the Ohio Small Business Development Center, we are an economic community development entity. We joined Columbus State in 2004. We are a part of a national network of small business development centers, 1,000 throughout the nation, nationwide. There are 25 that are located in our state. We service Franklin County and surrounding, so a 7-county region. If you are not in Franklin County, maybe are coming to us out of Cleveland or Cincinnati, there is SBDC offices that are available for you as well in those territories. We provide our services at no cost to you, so our trainings are provided at no cost. But in addition to that, our one-on-one counseling is provided to you at no cost and is available to you through the life of your business, as you can reach out to your advisor as often as you like for the needs that you have with your business. We also have specialty programs. Our export assistance network is there and available for you businesses that are looking to do export. And then we also offer bilingual services in Spanish. Today, we are going to be talking about the complete loan package, what it takes to prepare that package, how the documents that are a part of it. We'll review those, take a couple of look at some standard templates, and what questions to ask. This is an issue that many small businesses have, no matter the stage of the business, is that asking for money for their business is always a challenge, brings hesitation. And we're hoping that with this presentation today, that you're able to feel more confident in your approach in asking for funding for your business. Addressing the details, that's what's really big as far as in preparing your loan package, and it's understanding and knowing the process itself. So we're gonna dig down into what the process of actually applying for a business loan looks like. Knowing your business as well. So if you've had someone else prepare your business plan, you're going to want to take a step back. You want to review that business plan and really know the ins and out of your business. Making sure that your loan package is well prepared, and that is a part of making sure what the documents are that need to be a part of that package. Understanding how your lender will evaluate your loan request, what they're looking for, what needs to be a part of that package, how you may need to explain yourself further in the information that you provide to them. And then what are you bringing to the table? We'll talk about that. Is that money you've already invested, money you have saved, some sweat equity you've put in? We'll talk those things through as well. So I want to start with, first of all, there is no such thing as 100% financing. Now, I'm going to say that right off the bat. Now, there might be rare cases in where you will not have to invest any of your own personal funds, but in most cases, you are going to be required to put some kind of injection into your business or have a certain amount of your own funds set aside for the actual proposed amount that you would need for funding. And often that's 10, possibly 15%. And if you're talking about real estate, that could be anywhere from 15 to 20%. So it really just depends. But you still should prepare as you're looking for funding for your business to have at least 10% of your total loan amount requested set aside. So $100,000, you want $10,000 set to the side, money that you've saved up to put towards your business. Your personal credit is important. With startups, of course, you have no business credit. And so your personal credit is something that is really evaluated, and your credit score is going to be taken into consideration, as well as any types of collections, judgments, any type of legal actions that you've done in the past, bankruptcies and foreclosures, and how you utilize your credit card debt. As far as the high limits in comparison balances that you may have outstanding. So your personal credit is very, very important as you are a new entrepreneur pursuing funding, but it is equally as important as an existing business owner who's looking to get funding for expansion or new equipment and so forth for your business as well. The personal credit is something that is never overlooked or not a part of the equation. So you always want to make sure that you're maintaining good personal credit, you're aware of what's on your credit report, and that you're maintaining a good credit score. Third, personal guarantee. So though you are starting a business and your business itself is its own entity, it's going to take on its own life of its own. It's going to have its own EIN number, which is like its social security number. It's going to have its missions and value statements and so forth, which is kind of building the character of that business. But it cannot stand alone when it comes to funding. So when you are pursuing funding, not only are you going to be required to invest in providing your personal credit, but you also are then going to be required to sign as a personal guarantee. So acting as a co-borrower for your company as well. And then fourth, no government grants for individual small businesses. Now, I'm saying that, now that's 95% true. There are rare occasions where the government may step in and provide grants, or state and local agencies may provide some type of grant funding, but they are very specific. They are usually for businesses that have been impacted in some type of way, or they're industry specific, or they're to meet a specific goal as far as helping businesses acquire equipment. So they're very, very specific. So don't go into the mindset of going in for funding that you could possibly get a grant, because the likelihood of that is slim. And then outside of government grants that might be available, if there are other kinds of grants that are related to your industry or you being a woman or a minority, they are very competitive based. So again, you want to make sure that as you're thinking about your funding, you are really taking into consideration that you probably are likely going to have to take out a loan. And then if you get some other kinds of funding, be it crowdfunding or grants or something like that, then that's just an add-on. And then lastly, the SBA does not lend money directly. The SBA has positioned themselves to provide guarantees on loans that they are then funneled through banking institutions, banks, credit unions, micro lenders, to where they will provide that funding to you underneath not only the SBA guidelines, but also the lenders guidelines as well. The SBA acts in that capacity as a guarantor as well, in addition to you being a personal guarantor on that loan. Rarely, 95% of the time, maybe 93% of the time, 98% of the time, you will not see the SBA provide any type of direct lending. During the pandemic, we did see the SBA step up, but it is because of a natural, because of a disaster that they then provided direct loans. That's not typical. When you're thinking about going for funding for your business, you want to be very clear as far as what is the purpose of those funds. What are they going to be used for? You are going to articulate that not only through your numeric financials, your numbers in your business plan and your projections, but then you're also going to have to articulate that in your narrative of how these funds are going to be used. And you need to be very clear as far as how much money that it is that you're asking for. So purposes of funds from working capital, equipment, launching a new product, branding, startup, and so forth. So that would be the purpose of your funds, right? And it can be a combination of all of these things. So for example, let's say we have a startup business, you're looking for funding for startup, okay? And a part of that startup is going to be buying equipment. And so let's say our request is for 50,000. 10,000 is for equipment, 10,000 is for marketing and branding. 10,000 is to secure our brick and mortar space. And then we have 20,000 that's going to working capital, which could be for payroll for the staff that you're going to need to hire. And so the purpose of funds is broken down not only in regards to what the use of the funds is going to be for, but also what is the total amount of those funds that you are asking for. Again, how much of a loan do you need? You never want to go to a lender or speak to a lender and tell them that you're needing some funding for your business and you can't answer that question. So you want to make sure that you know how much money you need, but not only how much do you need, how is it going to be used, right? And understanding what the purpose of those funds will be for. Remembering that 100% of the financing is not an option. So 10% at least needs to be money that you have set aside and are able to invest. So again, so using that example of $50,000 for a loan request, 10% you would want to show in your bank account, $5,000, that money you've saved up to invest in yourself. And this is again, whether you are a startup or an expanding business. It's not a good idea to finance an entire salary in your request. So if you're starting your business and you say you're looking for $100,000 and you want 80,000 of that to be your salary to get you started, they're not going to like that. They're going to frown on that because they're anticipating, these lenders are anticipating that you are going to be bringing in revenue, bringing in sales. And from that, you will be able to take some salary. Now, I'm not saying that you can't put some salary in there for yourself. You would just not be putting in a substantial salary that you would be wanting to finance through a lender for the startup of your company. What always is good for me, that I think then I recommend to my business owners is that you put in there about 3 to 6 months of working capital. As far as in your projections, that working capital not only includes your rent and basic other expenses for your business, but it can include a small salary that you have in there for yourself as well. Collateral. So we've talked about how much the loan request would be. We talked about how that money is going to be used. And then we want to talk about how are you going to offer some kind of collateral for the funding, for the money that you're asking for, right? So just like you would buy a car, when you go to apply for a car loan, they're looking for the car to be your collateral. You're buying a home, the house is collateral. Well, with a business, it's going to be the things that are related to the business and how you're using that funding that could potentially be collateral for you. So if you are buying a van for the business, the van is collateral. If you're buying a commercial piece of real estate, of course, then the real estate is collateral. If you have contracts very well can be collateral that can be used for your funding request. And then inventory, supplies, and customer list and so forth also has a value that can be used as collateral. And then equipment, of course, as well too. So all of these things, as you're thinking about your loan request, you're wanting to think about how you're checking these boxes and what you bring to the table. As far as being able to show that this is a strong deal that you're presenting to the lender, that you have offered limited risk because you are investing in yourself, you have some collateral that you can invest as well, and you of course are going to be signing on the loan as a personal guarantee because again, you are a part of that collateral as well because you are guaranteeing that loan, maybe guaranteeing that with your personal assets, your personal income. And so you are also collateral that is a part of that loan scenario. So now let's talk about the kinds of loans that are available. You know what? I'll pause for a moment. Let's see. Do we have any questions? Any questions so far? You can take yourself off of mute and ask your question. All right. Keep going then. All right. So as you think about your loan, you also want to think about the kind of loan that you want, the type, the term, kind of rate you might be getting, what kind of fees you might have to pay, right? So, and these are questions that you can ask the lender. What kind of loans do you offer, right? Are they contract financing? Are they financing for equipment? Are they SBA backed programs, which is an SBA 7A or 504? Are they loans that are for startups? Are they just for existing? Are they offering loans for your particular industry, right? Terms of loans. Okay. Terms or loans is how long do you have to pay that loan back? If you have let's say a very a short term loan, but you have an excellent interest rate, the term of that loan still can hurt you and be impactful to your business because the payment still could be very, very high. And so the term of the loan is important as far as calculating what your payment is and calculating how that payment is going to affect your cash flow. So you want to know what the terms are offered on their loan products, be it a regular closed-end loan, meaning that you're borrowing the money and you're paying the amount that you borrowed right back, or if it's a line of credit, meaning as you borrow money and you pay the loan back, money becomes available to you again. If it's contract financing, if you're borrowing the money based on your contract and as your invoices are paid, they're taking that money. So you want to talk about what's the types and what the terms are. In addition to that, what fees might you have to pay? Fees up front as far as your application fee, fees for going into an SBA loan. There's often some fees that are charged and may become a part of your loan up front. Fees as far as late fees, prepayment penalty fees. If you were pay your loan off early, that's a prepayment penalty fee. Late fees, fees that if you didn't make your payment on time, what kind of grace period that you have. Often these loans do have some kind of grace period, usually 10, maybe even 15 days before you're assessed a late fee. But if you are assessed a late fees can be kind of hefty. And then what kind of rate do they offer? Do they offer fixed rates or do they only offer variable rates? So fixed rate would be where your rate would stay the same for the term of your loan. So if the rate is 9% and the term is 36 months, it would stay 9% for the full 36 months or 3 years. If the rate is variable, the rate can change. So year 1, it's at 9, year 2, it's at 10, year 3, it's at 11. And so therefore your payment would be going up, right? And this is important because again, you want to know what your payment is going to be so that you can account for it in your cash flow, in your financials, just like you are everything else, okay? And so it's important to understand what your term is, what your rate is, and then any kind of out-of-pocket costs that you may have as far as fees or fees that are being added to your loan itself, increasing your loan amount. Now, we've got the term, we've got the rate, and now we'll be able to understand what the payment would be. So understanding and asking those questions up front from your lender of what they anticipate your rate would be, what kind of payment term they can offer, what your estimated payment amount would be. That payment amount is something that you're going to want to now add to, whether you're existing or a startup, into your cash flow projections. So that the lender is aware that you are thinking about how you're repaying that loan, not only in your financials, but also in your narrative, because you are explaining in your financials that through a certain amount of sales monthly, you're going to generate a certain amount of income, and that income is going to be used to pay for your expenses, which should include your loan payment. And so they're seeing how you are generating sales to make sure that you're able to account for all the expenses that you have coming into your business, including your loan payment. You always want to talk about how you're going to be able to pay back this debt in your conversation with your lender, how you're going to be able to generate sales, what kind of money those sales is going to make, how you're going to be able to pay this payment. If you're going to pay it back early, that's great. You always want to be thinking about how you're going to be able to repay this debt and showing that in your numbers, your financials, as well as in your narrative. So now let's talk about, we're going to actually pull this package together and we're going to go for this funding that we're looking for. Again, we're going to use this $50,000 and what all this is going to look like, just to give you a high level overview of how you'll be preparing. And then if you find that you need additional services to help you in preparation for funding, you always can feel free to reach out to your SBDC advisor for additional assistance. So a part of the loan package is the business plan, which is again your story about you, your business, your roadmap to your business through narrative and financial documents that you're including. And then other required documents that are part of the lender's their own loan package. So there might be different disclosures that they're going to ask for you to sign. Personal financial statement is one that you'll find with every lender that you deal with. And then your actual financials. So for those that are startup, you're going to project financials, which are a part of your business plan. For those that are existing businesses, your financials are going to be your historical documents, tax returns, profit and losses, and balance sheets. And so the business plan, first and foremost, doesn't have to be an 80-page document. It does need to be very thorough, though, as far as your explanation of the problem, the solution, your product or service that meets the solution to the problem, the pricing of what it would cost somebody to acquire your product or your service, who that customer is, what do they look like, where do they live, how do you reach them, how can you communicate with them, how can you get your product or service in their hand, who your competitors are, who are you competing against, how are you different, how are you the same, how are you putting yourself in the marketplace to a share. And then also then what are the basics of your operation? How who is operating in your business? What role are you playing? Are there other key members in your business? How are you delivering or preparing your product or service? How is it being packaged? All of those things need to be part of your business plan in the narrative, translated into the numbers as far as in your projections. Now, the most important parts of your business plan, in my opinion, is the executive summary. So that's typically the first page after the cover letter and maybe the index that says, what is this business? And that really is, to me, your extended elevator pitch that's explaining who you are, what this business is, why you're doing it, how much sales you're going to make over a certain period of time. That executive summary, the lender should be able to read that and quickly understand your business and your business model. Now, for businesses that are a little different, more creative and so forth, in your business plan, you're going to want to add additional context because though lenders deal with multiple and different businesses, if yours is kind of unique, don't make the assumption that they should just understand or they're going to read everything, right? You want to help give them some direction so they can do some research themselves to better understand your business and your business model. A next part of the loan package are some documents that are going to be required. So your required documents are going to, of course, be the business plan, right? We've talked about that. And then for those that are startups, of course, projections where you're basing your numbers off of a pricing sheet for services and products, and then how many customers you're going to be able to serve. And from those numbers, you are therefore creating projections as far as a cash flow, a profit and loss, and balance sheet. Again, if you need assistance with these kinds of things, you can reach back out to your SBDC advisor. If you have not connected with the SBDC and have just joined us for this session, you will want to make sure that you are connecting again to make sure that you're letting us know that you would like to connect with an advisor. For existing businesses, you are going to be providing all of your business financials for the time that's been in operation for at least back 3 years. Okay. If it's only been 2 years, then of course you provide 2 years of the business financials. If it's 1, it's 1 year. And then overall, both applicants, startup and existing, would be providing at least 3 years of tax returns. And if they include the business financial, of course, is based on how long that business has been in operation. So 3 years of business tax returns. If you have secondary sources of income, you're going to be providing retirement statements, Social Security award letters, 30 days worth of pay stubs, W-2s for at least those 3 years as well. If you've recently been employed, you will provide employee letters and so forth. So you'll be documenting the income that you have coming in, not only for the business, but also through yourself personally. Because remember, you are signing as a co-borrower on these loans. You will also be providing information that's very specific to the business itself. So if you're a limited liability company, you will have an operating agreement. Now, that is not where you register with the state of Ohio. The registration with the state of Ohio is simply that. It's just a registration with the state, letting them know that you are operating a business under a certain name of which you've identified, and that the structure is going to be limited liability, corporation, profit, nonprofit, so forth. There underneath those different classifications are operating and corporate agreements and so forth. So limited liability companies, you will need an operating agreement. Partnerships, you will need a partnership agreement. Corporations, you will need corporate documents. So you'll want to make sure that you have those as well. If you are currently in brick and mortar or intend to lease a space, you'll be providing your lease agreement. You'll also provide any other kinds of legal documents that are related to your business. That would be licensing for you to be able to operate, certifications if that's something that is required. Any kinds of, for medical, for example, we want to see that you have the Medicare, Medicaid approvals if you're going to be billing for Medicare, Medicaid. So anything like that, vendor, you want to have a vendor's license. You want to have those legal documents be a part of your application process. Also, startup, you will get a estimate for your business liability insurance. For those that are existing, you would want to have your current policy be a part of your package. For those that operate in your business besides yourself, as well as yourself, you would want to include resumes, and those should actually be a part of your business plan. Resumes in the business plan that identify the skill sets that not only that you have, but key people in your business have as well. You're going to verify your 10% that you would be injecting into this as your owner's injection, and that would be verified through checking account, savings account, stocks, bonds, wherever you're going to be pulling that money from. And bank statements. So bank statements personally, 3 months, bank statements business, 3 months. If you're newly getting started, you will want to have that business account registered, your EIN number, and then of course identifying information like your social security card and driver's license. So that is the general part of the loan package. And then the lender is going to have some of their own documents as well. So they will be requesting possibly that you sign some documents that you're not delinquent on any kind of federal debt. So that would be like SBA loans, FHA home loans, veteran loans, USDA loans, student loans, delinquent on any kind of child support. So they may have you sign an authorization around that. They may have you sign something that states if you're doing job creation, because that may help them provide you some additional assistance and funding through some funding that might be available through the state. Personal financial statement, we're going to talk about that. The personal financial statement is, again, an evaluation of you personally, your assets, your liabilities, sources and uses of funds. So I mentioned that early on, that you want to be very clear how you're going to be using the money that you're asking for. Be very clear as far as the requests of the amount that you need. And so there's you can either type that up as I need this amount for these purposes, or they very well may give you a form for that. In addition to that, if you are an existing business, they very well are going to ask you for a schedule of debt. And that schedule of debt is going to include the lender's name, their account number, the rate, the term, and the outstanding balance. Also, what could be requested from you as a existing business is for an aging accounts receivable and accounts payable. So those are items that are asked for an existing business owner. So now let's get into, so we've went over documents that you would be required to put into this loan package. Now let's look at a few of these documents. So the personal financial statement seems to be the one document that everybody seems to get stuck on. For whatever reason, I'm not really sure. I want you to think about this as simply, it is your assets and your liabilities, and it is your liabilities that are truly reflecting on your credit reports, okay? So the personal financial statement is for you personally, has nothing to do with the business. It is all about what you have and bring to the table. So on this document, you want to make sure that you read all the small print, especially for those that are married, because it'll tell you how to fill this out. If you're including your if you're including your spouse's information or not. If you're including your primary residence, if you're a homeowner or not. So you want to make sure that you actually read the document when you get it from the lender. In this scenario, this is an SBA personal financial statement used for the SBA 7A and 504 loans. These two particular loans are used for working capital for startup and existing, and they are used for commercial real estate, the 504 as well. So in this scenario, we have assets on the left. As you look at the screen, we have liabilities on the right. The assets is any money you have in underneath your mattress, checking, savings account, money you have in IRAs or retirements. Now, mind you, you could be asked to provide the most recent statements. You want to make sure that it matches based on the time frame that you are completing this document. So this was done in September. Real estate. So in this scenario, we are providing, I believe, yes, the primary residence. And so this would be the estimated value of that property. If you've had a recent appraisal, you can use that amount. If you want to use Zillow to get an estimated amount for your value, that's fine. 230,000. Automobiles, even though they may have a lien against them, you still want to put the value of the automobile, as well as any automobiles, of course, that you have paid off that are free and clear. Automobiles that are titled in your name. Okay, let's be clear. Again, not the business, in your name. So automobiles, any other personal property that you have. Now, here, this would be items that are of value, great value. So collections, art, musical instruments, jewelry, that would fall underneath that personal property. Other assets could be other land that, well, no, land won't be there, like timeshares. That could be something that could be here as well. In the liability section is where you're going to be listing any debts that you have. Now, accounts payable and notes payable to banks and others. So accounts payable would be something like you have like a cognovit note that you've borrowed money personally from somebody and you're paying them back, something like that. Notes payable to banks and others, or it could also go underneath there. So this would be like your signature loans that would be underneath this banks and others. Notes to friends and family, again, only if there's an executed legal contract that's drawn up. Installment accounts would be like your automobile loans. In the liability section, you're putting the balance of these items, not the payments, the balance of these items. In this document where you see the $ monthly payments is where you'd actually put the payment, but the balance is what actually goes in the column section. Real estate. So again, if there's a lien against your primary residence or any other pieces of real estate that you have that you're listing on this for assets, you'd put the outstanding balance of that real estate. Unpaid taxes. This would be your personal taxes, be it federal or state. You'd put those there, or taxes that business taxes that you are liable for personally. That would also go there. And so then between your assets, subtracting out your liabilities gives you a net worth. Now, if your net worth is negative, then you're not in a good position to be a co-borrower on your loan, right? So that's why it's important for you to personally make sure that you are evaluating where you stand. Money that you've saved, debt that you have, debt that you've paid down, so that you have a positive net worth, you have a strong net worth to put you in a good position to be a co-borrower on your business loan. Then if you are a W-2 employee or full-time, part-time, you have some other sources of income, make sure that you're putting that in your source of income. I do not recommend quitting any jobs as you're starting a business. You want to make sure that you have that secondary source of income to be able to handle that payment as you get started. The second part of this is just then further defining what some of these items are, the notes to the banks and others, what these stocks and bonds are, further defining them. Real estate, what's the real estate that's mentioned as far as the asset, further defining what it is, and some of these other sections. And then you get to the end where you are signing it and dating it for the day that you completed it, because this would be based on that date only. The next day, it might be something totally different with your social security number. Now, let me go back. When we talk about life insurance, it's not your life policy amount, forbid something happened to you, that is talking about cash value surrender amount. So there are certain life insurance policies that you can obtain. I believe it's typically whole life, where you can pay into it and it builds up over time a cash value of which you can borrow against, or you can cash out that value. And so that's what they're referring to. If that doesn't sound familiar to you, then you probably do not have a cash value life insurance policy. So anyway, this is the personal financial statement. This is will differ from lender to lender, but this for the most part is what it looks like and how you would complete this document. Income statements or profit and loss statements are a statement that measures your business performance over a very specific period of time, depending on when the lender is looking for. It could be for the quarter, 6 months, for the year. And so I'm providing you an example so you're just, again, not intimidated in understanding what this document is. If you're an existing business owner, this is probably familiar to you. You may not know how to read it, but it is familiar to you. And if you are a startup, you will have to create this. And again, we can help you as the SBDC. But an income statement is nothing more than really a reconciliation of your accounts. It's kind of like balancing your checkbook. And so you're showing the money that's coming in. So that's our revenue, that's our sales. And then you're showing any expenses that are going out, which would include cost of goods sold. So money that's spent to actually create those sales or to sell that product. And then again, just general expenses. And that can be advertising, your owner's draw, fees that are paid to the bank, credit card fees, supplies and subscriptions, your insurance, your loan payments, right? Your loan payments, permits and licensing, contract workers, rent, so forth, and all of that. So in this scenario, we show that $40,000 is brought in. We're showing that there was no cost of goods sold and that there was $16,460 in total expense for a net operating income of $23,540. Now, when you're looking for funding, what the lender is looking for on this document is that you are profitable, okay? Profitable, because that profit is what is being used to make sure that you can repay your loan. And if you don't show enough positive profit to handle the repayment of your debt, then you are not in a good position for funding. So even though you're doing projections for you startup people, you still want to show that your business is going to be profitable to an amount that would be sufficient to cover your debt that you're asking for. And so normally they look at this on an annual basis. What if the annual net profit is compared to the annual monthly payments? Would it be something to cover? And it's usually at like 125% is what they're looking for. Balance sheet is assets of the business and the expenses of the business and how those are accounted for. Depreciation also includes owner's investment as well as owner's payments. The balance sheet is very similar to the personal financial statement that we just reviewed, but this is the business highlights. And so the thing to remember most about the balance sheet, even if you still find it challenging to review, you want to make sure that it always balances. If it doesn't balance, then I'm sorry, let me go back here. Screens are jumping ahead. If it doesn't balance, then you know that there's a problem with this document, especially if it's coming from your accountant. So when it balances, what you're going to see is that total assets equal total liabilities and capital. And in this scenario, we're seeing that number to be 56,300. And so this is an accounting kind of document. So what comes in goes out, right? So if you have assets, You're probably going to have some kind of liability. You acquired the assets some way, either from sales or from a loan that you took out, that helped to generate those assets. And so if you see assets on the other side, you're going to see some kind of liability in some case. So as we look at these assets, we see accounts receivable, which means that something has happened. You've made a sale. You're sitting and waiting on $4,000 to come in. But to create that sale, some things had to happen, right? You had to pay for some supplies. You had to pay some payroll. People had to get out there and sell that product for you. And so as you look at the other side for liabilities, you see sales tax for the items that you've sold that now have to be paid, payroll taxes for the people that helped to sell those items, and then even accounts payable. So maybe where you've got the inventory to create the product that you were selling. And so these are where you see these costs coming in, these liabilities to help generate, which would be your accounts receivable or your money sitting in your checking account, or merchandise that you have in inventory that is still there and available because you've spent some money and you've generated that from, maybe it's the note that you took out. And you see that in the liabilities and capital section, 25,675. There's a note there. What did that note pay for? Looks like it might have paid for a vehicle, because I see a vehicle as an asset for 30,000. Okay, maybe it paid for some furniture and fixtures, 2,500 there, some equipment, 3,000. Of course, the liabilities is going to go down, right, as you repay that loan, and it's not always going to equal what the assets were, but the assets are also going to depreciate as well. And so you'll start seeing some depreciation on your balance sheet too. Another part of it is, of course, the money that you've put in as the owner. That's an asset. It's an asset because it's money you've invested. It's money that's sitting there as far as an investment in the company, but it's also a liability because it's due back to you because it was personal money that you put in. And so in this scenario, we're looking to make sure that this document balances assets equaling total liabilities and capital. If it doesn't balance, there's something wrong with it. This is my most favorite document. I think this shows more so for me the most in a business and what's going on, what's happening, how you can make changes and adapt in your business. And that is by looking at the cash flow. So the cash flow is showing the movement of the money coming in and the money going out, money coming in and money going out. It's showing you how many sales that you need to make, how much revenue those sales are making. It's showing you how sales fluctuate from month to month. It is the flow of money, right? So this cash flow scenario is for a startup company. And I did this because I wanted to just reiterate again, our loan funding request, our source and uses of funds, calculating our payment, and then of course, our flow of money coming in and out. So with this, we're saying that we are needing $55,000 to get this business off the ground. Out of that 55,000, we're showing a beginning cash balance of $5,000. Now that's going to be our owner's investment. That's that 10%. The other 50,000 is our loan proceeds, right? So it's not sales from anything we sold. It's the actual loan itself. And then we're showing the breakdown of how that loan is going to be used, as well as the $5,000 owner investment. And that's spread amongst advertising, a delivery van, insurance, auto insurance, inventory purchases, the security deposit for the brick and mortar space, some professional fees. We've got an attorney involved to provide some legal contracts for us, the rent and lease for the space itself, some subscriptions and dues, supplies, and so forth. So those costs come to $37,700. We've left ourselves some money. That money is now our working capital. So that's reserves that we've set aside, $17,300, which flows into our first month of operations to make sure that we have some money there and available as we get things started, right? But this is a very aggressive business, and they were able to make sales right off the bat. And so they made $30,000 their first month of operation. Now that's rare. That's not likely, right? Every business is different. And so you want to be mindful too, as you're doing your cash flow, especially startups, that you're putting a number out there that makes sense as far as the amount that you're showing in relation to your product or sales, your average sales price, and the number of people that you can actually attract and get them to buy your product within the first, second, third month until you actually build up your customer base. And for your existing businesses, this just is what it is, right? And so it can allow you to see if you need to ramp up, do more marketing, if you need to maybe take out a loan to hold you over during times where things might be a little thinner. And so we have the 30,000 in sales that comes in October, and that added to the 17.3 gives us more than enough money to handle the monthly expenses, to handle our loan payment, 1,150, and for the owner to take a draw. And we go on. And as you go through this, you see payroll starts to kick in. Now we're bringing in staff and we're adding that payroll. We started with 7,800. Payroll grew to 10,400 in January, as also our sales grew. So the cash flow shows how these things grow. You purchase this for startup. For existing, it is what it is, but this picture shows you how you need to make changes. So now let's consider some helpful tips and pulling this all together. So you want to be brief, to the point, and it needs to be easy to read. Your business plan, your executive summary, and the documents that you've included in your package. You want to emphasize your business's management strengths, not only in your narrative in your business plan, but also in your you can use your resumes and your key people's resumes to show how you can make this a successful business under your leadership. Your loan package should be presented with attractive projections that paint a realistic picture. So again, that's where I'm saying you want to make sure your sales are realistic, that you've really taken some thought into the actual expenses of your business. Throughout the package, you want to weave in the theme of how you're going to repay the payment, that you know that there's a payment that's going to be due. You're cognizant of that. You're going sure that that gets paid. You want to make sure that you proofread the information that you're providing. Please do not provide a package with coffee stains and so forth. If you spilled some coffee because you was just so stressed out and trying to pull this all together, recopy the page. Just make it a clean page. And the bottom line is that you are having to convince the lender that your business is a reasonable risk, not only because you are done your due diligence to put yourself on a strong base to build your business, but you have the skill sets to be able to run and operate the business, not only the business, but also the idea that you're wanting to develop your business around. Where you might lack in some experience, you've brought in key people, or you've supplemented with outsourcing and for outsourcing services, maybe like payroll, HR services, and so forth. And that you have it personally evaluated for yourself, so that these things show up in your presentation. Your character, that's going to go fall back to your credit, how you operate, how maybe you've operated businesses in the past, your capacity, your ability to repay the loan, maybe from your personal income, your assets, but also from the business profitability itself, and maybe projections that you're showing as well. Your credit, that you've done some work with your credit. Even if you started with the lowest credit score, you can show how you've maybe paid down debt, paid off some credit issues, how you've better positioned yourself for this loan, and then how you are looking at collateral that you can offer. Collateral as far as your signature, collateral as far as items that you're buying, and so forth. All of these are given as far as consideration in making your loan and making the loan decision from the lender. So with a business loan, it goes beyond your credit score. It goes beyond your debt ratio. It is a conversation about all of these different things that are presented when you are considered for funding for a business. And then finally, if you are rejected by a lender, don't fret. Don't fret. You want to always reach back out to them and find out why you was rejected, fix those problems, and go on to the next lender. Every bank, credit union, micro lender, CDFI that's offering funding to small businesses have their own unique guidelines, rules, regulations, niche, likes of different industries and dislikes and so forth. So it may not just be the appropriate fit for you, that particular lender. And so therefore, you want to just take what you can from that. If you have a rejection, go back and fix it and move forward. There are some questions that I would like for you to always consider. We'll send this out to you as far as when you're looking at a lender, because not only are they looking at you, your character, your collateral, your credit, you should be evaluating them as well. And you should be looking at the loan products they offer, the rates and so forth. And so you want to ask right off the bat, how long will it take? From the time that you present them with a full loan package, that means your business plan, your financials, all the documents they've asked for, all the documents signed and delivered to them for you to actually get funding if you are approved. That's imperative that you know the answer to that, because depending on your business, timing could be of the essence. And unfortunately, right now, a lot of lenders are really far behind with their funding right now. So 90 days should be something that you should expect, and it can be as long as 6 months. So you need to really know what is the time frame and turnaround. Do they have a credit score requirement? If they have a credit score requirement, you don't meet that requirement, you automatically know there's no point in applying with them and having another ding on your credit report. Do they offer fixed or variable interest rates? You may not want a variable interest rate. You may only be looking for fixed interest rate. And if they don't offer that, again, no reason to look at applying. Do they provide funding for startup businesses? If they do not, then that's not the bank for you. When will your first payment be due? Do you need to have an established business checking account with them? These are all questions that you want to think about asking them. What kind of collateral is asked for? A lot of times, if you go over $150,000 loan and you have a home, a primary residence, a piece of real estate that you own, they will ask for an interest in that real estate, so a lien against your home. So you want to ask what kind of collateral is required. What kind of investment are they looking for from you? Is it 10%? Is it 5%? Is there nothing? Is it 20%? To make sure that you're in a position to be able to meet that guideline. Credit. Again, understand they're pulling your personal credit. Just get that out your head right now that they're not going to. They are. Credit again is credit score. It could be also a time period from when you might have had a bankruptcy or foreclosure, maybe something around if you have any type of tax liens, if they're on a payment plan or not. So you do want to ask about credit. Other things that may come into question as you start the process is if they are interested in your industry at that point in time. So that's always a good question. Sometimes businesses shy away from trucking different periods of time, restaurants at different periods of time. So you want to ask those questions. There are numerous resources that are available for you in Columbus surrounding in the state of Ohio. The Small Business Development Center is just one of them. The SBA offers resources, SCORE offers resources, the Minority Business Assistance Center, and the Women's Business Center. Now, these different services are changing and going through different modifications as far as what their programs can offer and so forth, but they are resources that are still available to you. You want to connect with them now so that you understand what changes they may be going through, and these resources are provided to you for free, so why not take advantage of them? Your next steps is to reevaluate your business plan, revamp your statement of purpose, meaning what is your loan amount for? What is the loan amount request? Collect the documents that you have handy if you need assistance with other documents or to evaluate what you're doing and putting that loan package together. Schedule an appointment to meet with an SBDC certified business advisor to help you through this process. Funding opportunities with the SBDC, we serve for-profit and nonprofit, startup and existing. Now, to the capacity that we serve nonprofit businesses with funding is through our Kiva crowdfunding platform. For the most part, our services are then offered there for-profit businesses, startup and existing. Kiva is a micro lending product that we do offer, that is offered through the SBDC. It is a crowdfunding product. That is something you can visit with me on at another time. We do have a webinar on Kiva as well that you can take advantage of watching as well, or join me for a virtual session of Kiva. It is a platform of which there are 0% interest rates. It has a 36-month term and funding up to $15,000. So it's a little more involved than that, but that's just to give you a very high level of what it is. It is engagement of friends, family, and community where they are investing in you with small bits of money. $25 is the minimum investment to help you obtain a loan. And then that loan, as you repay it, that money is paid back to them. So that is a product that we offer as the Small Business Development Center to help bridge the gap. Thank you for joining me, taking time out of your day to learn more about preparing your loan package. And just know that the Small Business Development Center is here to assist you in however capacity we can to help you build a strong, thriving business. Thank you so much. Have a great day.